Hi, everyone. So let's talk about investments. We are, as Seth and Mark mentioned, we've had our approvals, the investor wallet's ready to go. We've put together our first investment product, the Pynk Thesis portfolio, and it's ready for launch immediately. And I want to just introduce you to it quickly. But first, a couple of slides just on background. So, importantly, in launching the product, we're aware of the market conditions. Market conditions today are at extremes. The bond market has never been higher. Bond markets internationally in the developed world have never been more expensive. Stock markets, by virtually every measure, are as high as they've ever been, or higher than the tops back in 2066-29. It's just we're at extremes, and as you often see at tops. We have a situation where you have narrow breadth. The leadership is in the tech stocks, and this is a momentum-driven market. It's a get-rich-quick market. People are latching onto things that are moving, riding them, switching onto other things. This is a market that you have to be very, very cautious about. All the data out there shows very clearly that if your investment strategy in a market like this is to buy the market indices, things like the S&P 500, your expectation over the longer term, say over a 10-year period, can be, break even at best. You won't make any money. You may make some money, over the next year or so, and then you may lose a lot of money and then begin to claw it back. But over the longer term, you won't make any money if you buy the market averages. Now, the good news is that below the surface, because it's so volatile, below the surface, there is a lot of value. There's value in the commodity sector. There's value in the value sector. Until recently, in the small cap sector, there's actually quite a lot of decent value below the surface, and we're going to capitalize on some of those opportunities, as I'm going to show you in a minute. Our macro picture is that the market is clearly liquidity driven. It's all about government largesse. It's central bank accommodation, and more recently in the pandemic era, it's about helicopter money and governments facilitating economic growth. That's likely to continue. And our expectation is that this will begin to lead to inflation. We have not had a lot of inflation as measured by governments over the last 20 years. It's been, according to their measurements, in the neighborhood of, in dollars, and about 2%. Independent measures suggest it's a lot higher, but in any event, we're expecting a lot more inflation. And one of the reasons that we expect, there's a couple of reasons we expect that. So one of the reasons is the move to helicopter money. Post 2008, most of the monetary growth was basically led to sort of increased bank reserves and rises in financial markets. But now that they're beginning to hand money out directly to individuals, to businesses, et cetera, we expect that this will translate into a much greater velocity of money and more inflation. The other thing is that the scale is increased. Since 2008, the amount of money printing has been, dramatic double-digit growth in the monetary averages. But since the pandemic began over the last year, we're in uncharted territory. We're seeing across the world in developed markets, we're seeing growth rates that we have never seen before in times of crisis, in times of war. Never. These are off the charts. So this combination of helicopter money and this increased growth, and our belief is this is going to continue. The economies have become kind of dependent on it, and the problem is that all this money printing to suppress interest rates has led to increases in debt. And once you have this much debt, you need to continue the game, because if you allow interest rates to rise, it's going to cause problems for everyone. Another factor is U.S. market outperformance, which has been the case for some years now. And just as a matter of mean reversion, we're expecting better performance elsewhere, particularly in emerging markets, particularly because of the weaker dollar. I mean, I kind of glossed over the weaker dollar. The weaker dollar is a big deal for us. We think the dollar will. The dollar started weakening last summer. It's weakened quite a lot, but from high levels. We're expecting it to continue weaker. There may be some counter-trend rallies, but over the medium to longer term, much weaker. In part, this is because the U.S. has these massive imbalances in fiscal and trade imbalances. But looking back at the big picture, we have been, since the end of Bretton Woods, for 50 years now in the sort of petrodollar system, in a situation where the US dollar is about 65% of reserves around the world and about 80% of international trade. And the US economy as a percent of the world has shrunk. It's now about 25% of the world GDP, and about only 15% on a purchasing parity basis. And the US has to run trade deficits to supply dollars to the world, and it's just not big enough to supply enough dollars. We believe the dollar will weaken. We believe there may be some change in the monetary system, but we're not projecting that at the moment. A weaker dollar is a good thing for the world, and it's a good thing for a lot of the markets we're interested in. So environment is, we're going to capitalize on changing leadership in markets. This is a market where you have to actively rebalance the things we're investing in. You know, in a bull market, you can just buy and hold, and you usually do fine. In markets, in choppy markets, you can't do that. We also have to position for market weakness, because in a market that, you know, could continue to rise, but could fall at any time, you know, we're positioning ourselves to outperform by buying, you know, better value, things that'll bounce back quickly, but we're also going to hold cash to take advantage of that. Seth, if you don't mind taking us to the next slide. Okay, so I'm just going to talk quickly about how we form theses, and then I'm going to go show you a few of them. This is called a Pynk thesis portfolio. It's a broad, diverse mix of different strategies. Basically, the way we formulate these theses is we start by looking at change. We look at what's going on in the world, and you can look at this at the level of endogenous and exogenous change. So endogenous change, the investor perception to a large degree drives valuation and therefore returns. And we see a rotation, we're able to latch onto that. That exists within larger market cycles. You have seasonal cycles, you have business cycles, you have debt cycles that are longer. And we know where we are in these various cycles, and we're going to take advantage of that. One of the big plays here is going to be inflation. Exogenously, what we look at a micro level, at a macro level to determine at a micro level what to do. Monetary policy we've touched on. Technology, you know, in terms of, you know, new products, you know, for technology products, food products, a range of products provide opportunities, some of which we're going to capitalize on. Consumer tastes, regulation, for example, there's going to, you know, there's a sort of nascent cannabis market now, particularly in the US and Canada. We expect an enormous amount of growth, and we expect the current administration in the US to deregulate at the federal level and allow that to usher in. So that's one of the areas we're interested in. Demographics is always the biggest driver, so we watch that as well. In that middle section, we look at how that benefits different industries, different regions, products, etc. And then we try and understand where the value is going to come from, to what extent it's growth, and to what extent it's simply a re-rating, a new perception. No, if we go back to the other slide, sorry, Seth, just quickly. To put on a thesis investment, we look to double our money in 3 to 5 years, which gets us a minimum return of 15%. We only put these things on where we have very clear assumptions and logic that we can at any time monitor and determine whether it's still in force, so we can exit if it doesn't apply. We only go in when we think the probabilities are very much in our favor. We try and add to profits by trading around positions, and we size the profits based on their volatility. So some will be larger than others, depending on risk. Okay, next slide. This is the final slide. Just want to show you, this is our launch portfolio. We have about a dozen different theses. There are 67 stocks currently in the portfolio. They lean towards large cap. This is a highly scalable product. We will start with, you know, with a smaller portfolio, but the portfolio that we are launching with, we could put hundreds of millions of dollars into no problem. This is a very, very scalable product. You can see the different theses. Let me just give you an example of one so you get the flavor. I'm going to pick the third one there called life support. The life support, the idea here is this. There's clearly a growth market in electric vehicles and renewable energy and these related businesses. And various countries, various states, various companies have come out and said, we're doing these things over the next 5, 10, 15 years. Studies are out there. The European Union did a study recently, but there are many showing that the consequence for base metals, for battery metals, for a number of the things that support these industries there's going to be enormous growth. You're going to need 20-fold increases in lithium, huge increases in all kinds of metals. the way we're playing this sector through metals, through commodities in general. So in case of renewable energy and EV metals, you've got battery metals like cobalt and lithium and nickel. You've got base metals. You've got copper, aluminum, other things that are going to drive these things. There's going to be a huge uptake in these things. Specialty metals, rare earth metals, which are hugely relevant for the renewable energy sector. You know, hydrogen was a big thing last year. You can't, the hydrogen sector, as it's, you know, set up now, it can't grow to anything like where it wants to grow because there's a shortage of platinum. You need platinum for that sector. So we're going to play this sector by getting in there. Now, the good news is, awesomely good news is that, okay, a number of these sectors have caught fire. Iron ore, lumber, if you've been watching some of these markets, even copper. But in aggregate, because we're also going to be in agricultural and soft commodities, in aggregate, commodities relative to financial markets are as cheap as they've ever been in a century. There's only been 3 times in the past, 29, 79, and 99, where they've been this cheap relative to financials. And you always got a bull market. So that's in part why we're playing this growth area through commodities. Anyway, I've taken more than my time, so I'm going to hand back.
So thanks a lot, Mark. Hopefully that's been quite enlightening for everyone, because it's probably the first time you've had a real understanding of what's going into the launch portfolio. I can't wait to get my money in there, and we think that the crowd and the investors are going to be excited too. You can appreciate that actually the approach we're taking here with these different very focused theses gives us an opportunity to market them individually as a way to get people interested in the overall portfolio. So there's some quite cool marketing ideas coming through there as well. I just want to point out that none of that is investment advice. You guys are all sophisticated investors, but this video is being recorded and it may go out to the wider world. So obviously nothing that Mark said there was investment advice.